So as you guys can see here, my belief is that I believe yields will come down. I think defensive sectors will outperform. So that's where I'm looking at these healthcare companies, consumer staples that are paying dividends that are comparable to a 10-year treasury trading at 4.4 to roughly 4.5%. If I can get that in a dividend yield, but also be buying companies that are trading for single PE multiples that have top line revenue growth and EPS growth opportunities, then that's where I kind of want to be. I think that's what's going to outperform possibly over the next 3 to 5 years. Well, welcome in, ladies and gentlemen, to Compounding Capital. That's right, the name of the channel has changed and so has the direction, but hold on one second, let me explain exactly what I'm doing here. Financially Fit was created because I was in financial services. I absolutely hated selling products to people that they probably didn't even need. So I created a channel that was just helping individuals figure out a process and showing them how I arrive at prices, but basically bringing it down to one red cent on how to value individual stocks. Now on this channel, I always recommend just buying broadly diversified indexes, set it, forget it, and see you in 30 years. But for entertainment purposes and for my journey alone, I do like breaking down individual stocks. So let me explain why the channel is shifting. It's really scary and unfulfilling how accurate my videos have been versus the results of my channel. Meaning that I physically have shown you guys that companies like Tesla, Neo, SoFi, Open Door, Tattooed Chef, and many, many more companies were really overvalued and didn't have any true fundamentals underneath them. And in the end, that led me to getting no subscribers, a lot of hate on stocks that I broke down. And so going forward, I'm only going to talk about stocks that I'm personally interested in. I'm really focused on just building a portfolio from ground zero. And so let's get into exactly what I think is going on in the market and where I think we're heading and how I'm positioned. Now, I want to be transparent here and show you that I have been underperforming most markets. I'm down roughly 1.9%, while most markets are flat to slightly up, with the NASDAQ leading the way nearly 5%. And so I'm definitely massively underperforming the NASDAQ. This is why I say always just buy a broadly diversified index, because you don't have to worry about trying to beat the indexes. Now, for individual stock pickers, I really believe that if you're going to take the time, you should be measuring your performance versus the markets. Over the last couple of years, I have outperformed the markets. Over the last few weeks, I'm underperforming, but I truly believe the way I'm positioned longer term and the more positions I'm going to add into will outperform the markets, and I'll explain why that is. Now, it is my opinion that we're heading into late cycle where I truly believe companies like healthcare, staples, and utilities are going to start outperforming, and we're already starting to see utilities outperform, and we've really seen a spike in commodities as well, which is signaling a flock to safety when we look at the gold prices and silver prices now taking demand. I think fiscal stimulus has re-entered us into a bull market when we think of where a lot of the money has went, whether that's the CHIPS Act, the IRA Act, and the talk of AI has led us to extend this bull market, but I still believe it's long in the tooth, and I still believe we're heading late cycle to possible recession by 2025. And so I'm positioned a little uniquely here where those sectors I'm mainly focused on. But in this video, I also want to talk about a position that I'm looking at building into here very soon as well. So as you guys saw, if we are heading into late cycle, companies that are in the healthcare sector, utilities, and consumer staples have the ability to outperform. Now, the interesting thing about those sectors, especially healthcare and consumer staples specifically, is there's two tailwinds I think these companies have had. Number one is healthcare and consumer staples are deeply undervalued in my personal opinion, and they also pay dividends. Now, dividends to me are not usually important, but when we are heading into the valuations that we're heading into, when we're talking about the markets trading at over 22 times the earnings, and we start looking at historical averages, I do believe dividend paying stocks could outperform in the near term to medium term. Basically 1 to 3 years, I believe dividend stocks can outperform. And so when we think about sectors that have underperformed, that being healthcare and consumer staples, those might be areas we might want to start looking at putting money to work. And that's exactly what I've been doing. Now, if you've been following the channel, you guys know I had a few other positions. I consolidated those positions and bought Bristol Myers Squibb on the dip, getting in right around $41 a share, which was paying over a 6% dividend. The same case was made for Pfizer as well, getting it close to a 6% dividend yield. Now, Cisco Systems to me is an interesting AI play in multiple facets. And so that's why I own Cisco Systems. When I look at the technology sector trading as a whole, very expensive, company like Cisco Systems pays a 3.5% dividend. As I stated before, I think dividend yields will outperform longer term here. And so when I look at Cisco Systems, definitely been an underperformer. I'm in right around $46.50, currently trading at $45.41. So down a little bit in this position, but longer term, really love the setup. And I do want to build this out to be one of my larger positions. Wouldn't mind buying closer to $12,000 or $15,000 total position on Cisco Systems. So you guys can start seeing the mindset that I'm having here. Now, I have price analysis for all these stocks that I purchased, and I've shared them with you guys. But to kind of breeze over it really quick, Cisco Systems to me definitely reached on around $46. As you guys can see here, $44 is about what I think fair market is. So ideally, you would like to get it underneath $44 a share. And we originally had a price target of $43 on this channel. And I do think it actually has the ability to reach those levels. And I have to be willing to buy more if I want to if I still believe in my thesis that this is a long-term multi-secular play from an AI perspective. When we look at CVS, once again, $57 a share. So anything under 56, I believe, is a pretty solid opportunity for CVS. They obviously have their headwinds, low margin business, but I do think they have enough levers to pull to actually grow their margins and their free cash flow back on the upside once again. Now, the new addition of Bristol Myers Squibb, you guys can see here, right around $40 a share. Ideally, I'd like to get it in $39 a share, but I started averaging in right around $41 a share. So solid, I think solid buy longer term when we think about that this is a company that could probably earn anywhere from $4 to $6 of EPS next year, which means it's basically trading in a single digit PE ratio and paying over a 6% dividend yield. So multiple reasons why I'm really liking the healthcare sector when we look at both Bristol Myers Squibb and a company like Pfizer. Now, these are not super sexy plays. These are not high growth plays. These are not 10x stocks, but these are consistent compounders, in my opinion. I think they have top line revenue growth opportunities. I think they can fix their problems, and they trade very cyclical. So the ebbs and flows, we're getting it on the low, where I think earnings have troughed, and we'll try to sell it close to the peak or limit our position as we get closer to the peaks on the earnings. So let's talk about a position that I'm thinking about adding into here. Beginning to see Barrick Gold as a possible interesting long-term buy and hold play here. Over the last 5 years, we've seen the price action go as low as $13 a share, as high as $30 a share, and now trading around $16 a share. And I'll explain what I like about the company here. I recently heard the CEO speak from Barrick Gold, and he's brought up some really interesting points here. The gold miners have actually underperformed the true underlying asset of gold, and their earnings are surprising to the upside. Revenue was slightly down, but EPS was a beat. So kind of a mixed earnings report. Now, longer term, this company is becoming interesting because they're starting to incorporate copper as a larger part of their excavation. By 2028, they're projected that 25% of revenue is actually going to come from copper, and we're seeing a high demand for copper as we're becoming more reliant on EV vehicles, build out of chips. And so the commodities of copper are becoming in higher demand, and we're starting to see copper prices spike, which should benefit a company like Barrick Gold. Number one, I do think that there's still a significant amount of catching up to go to when we talk about the overall underlying asset of gold. Number two is I do believe they have earnings per share growth within their company. Once those costs start coming back down, we're going to see companies like Barrick Gold actually grow free cash flow a little bit stronger, trading at a forward PE of 15 times earnings. And when we look at a dividend of 2.5%, nothing super exciting there, but when we compare them to their valuations to their peers, from a forward basis, Barrick Gold's trading for a little bit of a discount here, trading at 15 times earnings, while industry standard is between 16, 17, and even 18 times earnings, pays an above average dividend yield, and going forward, I think they're going to be more diversified than most. The other thing I like about the company is the fact that their net income margins are stronger than their peers. So better margins, better growth opportunities, above average dividend, and a basic market multiple at this point in time. I do think that there is some underlying value here. Now, before we get too excited about Barrick Gold, this is not one that I would really go all in on, because I do think we could see a significant sell-off in precious metals. If we go into a recession, we could see a significant sell-off in the precious metals as kind of the knee-jerk reaction, which would blend a buying opportunity for Barrick Gold. Now, I'm going to eventually do an analysis on this company, but where I get really interested in this company is below $15 a share, which means that roughly 8 to 10% drop here probably makes it a buy territory for me personally. So looking at Barrick Gold, a few reasons why I like them. I don't ever like owning gold. It's just kind of a buy and hold, and I'd rather own the gold miners to get the beta, but also have the exposure to gold. And they've definitely underperformed the underlying asset. But longer term, I do think that there is a catch-up trade here when we look at gold miners and the recent underperformers of companies like Barrick Gold. So this might be one that I'm adding into my portfolio. I also think it plays a little more defensive. If we really believe that there's going to be a long-term demand for copper and gold, then this company is obviously positioned well longer term, and it does return capital in the form of a dividend. So multiple reasons why I think this would be an interesting longer term buy and hold. And in the next video, we're probably going to do more a fundamental analysis on the company, plugging into the model and seeing where we come up with for fair market value on Barrick Gold. But this is definitely one that I may be adding a small position into the very, very near future. Over the next year, I definitely think you still want to stay in your technology plays. The momentum is there. But when I think longer term and where the economy could be heading, I want to be more exposed to dividends and underperforming assets that are trading for low multiples that have pretty resilient earnings growth. And that's where I think the outperformance can come over the next 3 to 5 years. As always, guys, this is just my opinion. Appreciate your time. We will see you in the next one.